Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's June 16th, 2013. Stock prices slipped again last week, but while the number of 100-point swing days has gone up, the overall point damage to the indices has been slight. And there's a good chance that prices move up again this week. Number one is the Federal Reserve meeting coming up on Wednesday. In the last couple of decades, most of the gains in stocks can be attributed to the days around Fed meetings. While there's no guarantee for any individual meeting, there's a good chance that this week's edition will produce the desired effect. Since the Fed brought up the subject of dialing back on its quantitative easing last month, stock prices have been halted in their tracks. The indices have only lost 2 or 3%, very little given their runaway move prior to that. Bonds and currency prices, however, have moved a lot more, with the net result of it being that the Fed has let it known that it thinks it's been misunderstood. While I can't tell you what the Fed will say this week, this month's meeting does include a press conference with Chairman Ben Bernanke, and it seems unlikely he will want to introduce more turmoil into the markets at this time by talking up immediate cutbacks in the bond buying program known as quantitative easing. He might leave the notion out there, though, because the Fed has never said it intends to keep up the current program forever. So what we might see is a typical market rally up to the Fed meeting, followed by a bit of typical confusion after the meeting, and then afterwards the market will decide on its own what it wants the Fed to have really said. With the bank likely to revise its 2013 forecast downward, markets may perversely rally on that, deciding that a weaker outlook means more bond buying for a more comfortable amount of time. Another factor supporting stocks this week is the quarterly options expiration, also known as quadruple witching. There are millions of options outstanding on the S&P 500 tracking stock, SPY, that expire at the close on Friday. At last look, they were tilted about 2 to 1 in favor of puts, below the 164-165 range, which suggests that the SPY will finish at that level or even higher, making all those puts worthless. So unless the Fed surprises us, I would expect a gain of a couple of percent this week that carries us back near the highs. Whether that has any follow-through, though, is another issue, as June is usually a volatile month. And the Fed governors will probably run around afterwards trying to throw cold water on any moves that seem excessive. So be careful about interpreting any rebound as a signal to come racing back in. Markets often chop quite a bit in the summer, and rallies are often followed by even bigger declines. There hasn't been a pullback to the 200-day moving averages since last November, and that means prices are stretched, regardless of what your mutual fund manager might say. I'm Kevin Flynn, and thanks for listening to Avalon's Market Minute.